Hello, I'm Noelle Lim on ASEAN Speaks by Maybank Investment Banking Group. Our analysts discuss a range of issues today, from fuel subsidies in Malaysia to the Renminbi as a viable alternative to the US dollar and possible policy changes for Malaysia Plantations. Chua Hak, Regional Co-Head of Macro Research, takes it from here.
Hey, hi, morning. It's Monday, 28 March. So I think the big highlight last week was the bond market sell-off. Yields on the benchmark US 2-year and 10-year jumped to 3-year highs. Investors are expecting inflation to climb higher in the US, which may force the Fed to hike interest rates more aggressively. Actually, some of the foreign houses are calling for pretty aggressive cuts. Some of the US banks are calling even for 450 basis point hike, followed by 225s. Several Fed members are also voicing their views that a 50 basis point rate hike may be necessary at the next meeting. The 10-year yield ended 10 bits high at 2.47. That's a rate not seen since early May 2019. The 2-year moved up 14 bits as well. The yield on German bond also rose to 0.58% on Friday. That's the highest since May 2018. The Bloomberg Global Bond Index fell to a fresh post-pandemic low. But despite the jump in global bond yields, the MSCI Global Stock Index ended high last week, adding a second consecutive week of gains. The volatility VIX index ended 13% lower on the week, again, despite the geopolitics and more aggressive Fed. So investors too optimistic. The S&P and NASDAQ gained about 2% for the week. MSCI Asia Pacific gained a smaller 0.5%. The gains were largely driven by Japan, with Nikkei jumping 5%, while the Hang Seng Index was slightly negative and the China markets down by about 1%. ASEAN markets were slightly higher for the week, boosted by reopening, led by Singapore up 2.5%, Vietnam up 2%, and Philippines up 1.7%. Demand for safe haven assets, including gold and the Swiss franc, remain resilient as the war in Ukraine extended into the fifth week. In the FX markets, the US DXY dollar index rose 0.6%. That's a 22-month high. The euro fell 0.6% and the yen declined 2.4%. Commodity prices climbed, with the Bloomberg Commodity Index reaching 5.3% last week, snapping 2 weeks of decline, reaching a fresh weekly high. Brent crude oil prices were up almost 12% on a week to slightly over $120. And LMEX metal prices were up 1.3%. Gold was up almost 2%. On COVID, ASEAN continues to open up its borders. So I think the big news last week was Singapore and Malaysia will now be allowing vaccinated commuters and cars now to cross the causeway again on 1st April without testing or quarantine. About 300,000 plus people used to cross the causeway on a daily basis before the pandemic. Singapore will also be relaxing social safeguard measures significantly this Tuesday, with dining now limits now raised up to 10 from 5, and up to 75% can return to office. And they've also relaxed the mask mandate, which will be optional now for outdoor settings. But even as ASEAN opens up, the World Health Organization is warning that Europe is getting in the grip of a fresh COVID-19 surge. The rapid spread now is due to a highly infectious version of the Omicron variant known as the BA2. Experts are predicting that North America will be hit by a similar resurgence within weeks. This Omicron subvariant is estimated to be about 30% more infectious, but is no more lethal than the Omicron variant. Anthony Fauci said that he did not expect a surge in cases to require the reinstatement of tough social distancing restrictions. In China, which is still sticking to the zero COVID strategy, Shanghai is locking down this week half the city, given the 60% spike in COVID cases. On the war, it looks like the Russian offensive is getting bogged down and having trouble advancing, with the situation looking more like a stalemate and becoming a static war of attrition. The stalemate may be why Russia's top army commander said last week that the war had entered a new phase, focusing on the eastern Donbas region. This week, markets will be looking out for the worldwide release of manufacturing PMI for March to gauge whether there's been impact from the war. The preliminary release for the PMI for Eurozone and Asia has been somewhat resilient so far, but the prices sub-indexes show mounting price pressures from the supply disruptions caused by the war. The March CPI for the Eurozone will be out this week, including Germany, France, Italy, Spain, which will be in the focus after the ECB warned that Eurozone inflation could reach 7.1% under a severe scenario. OPEC and non-OPEC members will be meeting on Thursday this week to decide on production targets. The cartel has been increasing supply by the gradual rate of 400,000 additional barrels a day every month. And on Friday, the spotlight will be on the EU Virtual Summit with Chinese President Xi and Premier Li, along with the European Council President and European Commission President Ursula. So Ukraine, I think, will be on the top of the agenda. In the US, President Biden will be releasing his 2023 budget on Monday, which will provide a glimpse of his spending priorities. His approval rating, just to note, has fallen to a new low of 40% amid the war and inflation fears. Then all eyes will be on the jobs report out on Friday, which will, if it's going to be a strong number, that will almost confirm a 50 basis point rate hike in the next meeting. Fed Chair Powell has said that labor market tightening has reached an unhealthy level. And US PCE deflated out as well this week. That's the Fed's preferred gauge of inflation, expected to rise again to 6.4% from the previous 6.1%. In Asia, the key indicators will be the March PMI readings, especially for China. Vietnam will be the first country to release 1Q GDP later this week. Bank of Thailand will meet this week for its policy meeting and widely expected to leave interest rates unchanged. On companies reporting earnings this week, a lot of China results: Bank of China, China Construction Bank, BioNTech, CNOOC, BYD, ICBC, PetroChina, Porsche, Lululemon, McCormick, and Micron Technology. Focus as well could be on the Russian bond. There's a risk of a default when 2.2 billion comes due on 4th of April. That's after the previous relief when Russia actually made the 117 million payout. But now 2.2 is a far, far bigger sum. Today, we have Suhaimi on a possible policy shift in Malaysia on fuel subsidies. Saktiandi on whether Renminbi will emerge as a viable alternative to the US dollar as America weaponizes the dollar and financial system. Zamros on the Philippine Central Bank meeting last week, Chua on her GDP downgrade for Thailand, and Maria on views on Thai company earnings, and Ong Chee Ting on India's decision to replace the palm oil export curbs with an export tax. So let's kick off first with Suhaimi. So I think Malaysian Finance Minister said fuel subsidies may reach a whopping 28 billion this year. That's more than double the 11 billion cost last year. I think the budget assumed $67 oil, and now oil is well above 100. So what are the options on the table to reduce fuel subsidies, and what is the most likely option?
Hi, good morning, everyone. I think with regards to fuel subsidy situation in Malaysia, we actually see three possible scenarios. Essentially by looking at the past episodes of fuel price changes when crude oil prices were above $100 per barrel. The first scenario is basically an inflationary removal of fuel subsidy, assuming complete removal of fuel subsidies as soon as next month. I think the unsubsidized RON 95 and diesel prices will mean 80 to 86% price hikes. This will basically result in 2022 inflation rate to shot up to as much as 8% as opposed to 2.5% recorded last year. And the last time we had a one-time big fuel price hike when crude oil price was above $100 per barrel was in June 2008, when petrol and diesel prices were raised by, I think, between 39% and 63%. And as a result, full year inflation rate accelerated to 5.4% in 2008 from 2% in 2007. The second scenario is a sequence of smaller fuel price hikes. This is something that actually happened during another and longer episode of above $100 per barrel crude oil price, i.e. between February 2011 and August 2014, which is a possible scenario as far as crude oil price current condition is concerned in view of the seemingly protracted outlook of Russia-Ukraine war. Back then, the subsidized fuel prices were raised twice during that period. The first hike was in September 2013. Prices were raised by 20 cents per litre, i.e. between 10.5% to 11%. The second increase was in 2014. Fuel prices were raised by another 20 cents per litre. That is between 9.5% to 10%. And annual inflation rate rose from 1.6% in 2012 to 2.1% in 2013 and 3.2% in 2014. So sequence of smaller fuel price hikes help to manage inflation impact. The third scenario, which I think is quite tempting for us to consider as the most likely scenario, is status quo for now, pending general election, because interestingly and unsurprisingly, RON 95 and diesel prices hike amid that episode of above $100 per barrel crude oil price in June 2008 and September 2013 happened 3 to 4 months after the general election back then in March 2008 and May 2013. I think the next general election is expected to take place anytime between middle of this year and middle of next year. We also wonder whether the government will raise fuel prices within the next couple of months, which coincided with the start of the Ramadan, to be followed by Eid celebration in early May. So under this status quo scenario, we expect extra Petronas dividend to foot the increase in fuel subsidy bill that is not covered by the higher oil and gas related revenue from this environment of above $100 per barrel crude oil price. And this is in view of the prospect of another windfall year for the national oil company in 2022 after the bonanza in 2021.
Okay, so the most likely option is for the government to wait until after elections before raising the fuel price hike. I guess postponing the inflation shock. So I mean, Malaysian trade data for February was also out last week. What are the highlights? Is there a slowdown or Malaysian exports still booming from the soaring commodity prices?
Number-wise, as of February, still clocking double-digit growth. I think in February, export growth was 16.8% year-on-year. Import growth was 18.4%, but it is moderating from January's figures of 23.9% and 26.7% year-on-year respectively. And for that matter, it has been on an easing trend since November last year, in the sense that, as of February this year, export and import growth were virtually half of their growth rates back in November 2021. I think as far as certain things to highlight, I mean, the numbers reflect kind of across the board slower double-digit expansion in manufacturing, agriculture, and mining exports. Manufacturing export grew 14% year-on-year in February from almost 20% in January, but really it's being supported by continued solid growth in E&E amid moderations in other key components within manufacturing exports. On commodity, I think by and large it is supported by commodity prices because of the, in a sense, continued robust growth in the value of exports of palm oil, LNG and crude oil, but things are a little bit more mixed on export volumes of these key commodities. Only palm oil registered higher export volumes, but we have lower export volumes of LNG and crude oil in the second month of this year. I think in the wake of Russia's Ukraine war, Malaysia's external trade outlook right now is a tug of war between the upsides from commodity prices and the downside from global economic outlook. Increase in commodity prices benefit net commodity exporters like Malaysia. For example, we estimated every $10 per barrel rise in annual average crude oil price can raise Malaysia's current account surplus to GDP ratio by 0.15 percentage point. But inflation risk from higher commodity prices and the resultant monetary policy tightening casts a cloud on global economic outlook. And we estimated that a 1 percentage point drop in global GDP growth can shave off up to 0.8 percentage point from Malaysia's GDP growth, underscoring the flip side of a trade-oriented economy. And the downside risk to global outlook right now reflects the risk of Russia-Ukraine war dragging the European economy.
Okay, thanks, Suhaimi. Andy, your ASEAN-X thematic is on the RMB, which is getting a lot of attention because of the Ukraine-Russia war. So will the RMB emerge as a viable alternative to the US dollar as America weaponizes the global settlement system, freezing a big portion of the Russian central bank reserves and banning Russia from SWIFT?
Yeah, morning, Habin. Very, very timely question, especially with the recent IMF paper as well. I think they've shared the share of global reserve currencies over the past 20 years and found out that the reserve managers have moved out of dollars in two directions. One quarter, 25% into renminbi, the other three quarters into smaller countries. Our view in the report highlights that, yes, economic sanctions on Russia may aid to some extent some yuan internationalization, but progress has been quite slow. The main thing is on the commodities front. I think Saudi Arabia are in active talks with China, for example, on oil deals. And on China's front, they are actually maintaining their energy consumption and all reliance of energy consumption in their mix still quite stable. So I think they're trying to maintain relations with crude oil producing nations like Saudi Arabia. And I think if those stocks come out positive, it could help, because Saudi Arabia is almost 20% of China's crude oil supplier in the mix of other countries in the Middle East. Russia is about 16%. Saudi Arabia is about 17%. So it will help. Second is in terms of commodities front and how actually yuan internationalization can actually help would be in terms of exchanges, for example. So China has actually launched energy exchange after the IMF's inclusion of Renminbi into SDR since 2015. Is some milestones in terms of yuan internationalization, in terms of cross-border interbank payment systems, and the inclusion of China into FTSE and others. So you've actually seen CNY actually aging Japan out of the fourth most active currency for SWIFT payment, for example. So, but the main thing is that it's still far from challenging the two top positions. So altogether, if you take all that data together, it suggests that the progress made by Renminbi as an active mode of payment as a reserve currency is rather marginal still, in spite of the key milestones. Could be primarily due to the capital controls still in place, which discourage FX speculations. And in addition, China does not have the complete payment infrastructure to be independent of SWIFT yet. The CIPS creation based on geopolitical purpose could actually be a reason for poorer adoption by Western banks. But there's growth in CNY usage. I shared just now. The SWIFT sanction of prior nations could actually lead central banks or other corporates to actually search for alternatives to dollar and euro. And China is actually the trade and has a trade and investment cloud as well as budding payment system in place to serve as one in future. And I think it will gradually increase, especially with the commodity support producers actually shifting. It will help, even though CNY in reserves is only about 2.7%, but it has actually increased exponentially. Abid.
Thanks, Andy. So I noticed that all your 5 thematic FX trades have been doing pretty well, particularly the G7 versus China policy divergence play. So I guess from now here on, which of the 5 themes, I guess 1, the reopening play, 2nd, the G7 China policy divergence play, 3rd, the benign commodity outlook, which I'm kind of surprised that it's actually a positive return, 4th, intra-ASEAN policy divergence, and 5th, US dollar long. Which of these 5 do you have the most conviction at the moment?
I think for now, because we've seen already the China policy divergence play making quite a bit of positive profits in terms of 8.7%, we were suggesting to take profits on that front. Even on the commodity outlook front, we think there's still some room. But in terms of conviction play, amongst that, I think the COVID endemic reopening play could place a bit of upside because it's only seen about 1.2% returns as the COVID endemic focus and opening actually comes out. I think the basket of equal weighted long Sing dollar, Thai baht, Korean won relative to Taiwan dollar CNH could see some upside. That could be one conviction, but we still continue to be positive on the benign commodity outlook. There's still some room from the 3.7%. We think as commodity could still see some upside by playing the Aussie, Indo, Ringgit, and Canadian dollar relative to INR, we think. So those are my conviction play is probably on the COVID endemic reopening play theme, followed by the benign commodity outlook for now.
Great. Thanks, Adi. Zamros, I think the Philippine Central Bank left the policy rate unchanged last week, but was a bit more hawkish because of rising inflation. So can you share the main takeaways from the meeting?
Good morning, Harbin. Morning, everyone. Yes, BSP held the second monetary policy meeting last week for the year. The first one was last week. Hence, they kept the policy rate unchanged at 2%. The main takeaway is basically on growth. The board now basically more optimistic on growth. Firstly, they're looking at the domestic economic growth to gaining stronger traction. mainly from the improved mobility and the gradual reopening of the economy, and as well as the progress in terms of national vaccination program. As far as inflation are concerned, they are now looking at the increased upside risk to inflation this year to breach the 2 to 4% target range for this year. But for next year, they're looking at inflation to be basically broadly balanced. Hence, BSP raised the average inflation outlook forecast for this year to 4.3% from 3.7%, which they make the projection last month. And for next year, they are looking at 3.6% average inflation versus 3.3% previously. But nevertheless, despite the optimistic outlook on growth, BSP also flagged the risks to their growth projection. Firstly, mainly from the resurgence of COVID-19 cases, not just in Philippines, but in other parts of the world as well. Secondly, from the rising and elevated commodity prices, and as well as the ongoing geopolitical tension, especially the Russia and Ukraine. And for inflation, basically they're looking at the continued upside risks from the domestic pork and fish supply, the possible increase in transport fares from the elevated crude oil price. Hence, they call for the continued non-monetary measures by the government to ensure limited impact to the consumers and to the industry. Fabin?
Yeah, so Zamros, just quickly, what's your latest view on the central bank policy?
So with the change in view by BSPs in terms of growth and inflation, we are now penciling in 2 rate hike for this year, 25 basis point at the end of the third quarter, and another 25 basis point at the fourth quarter of this year, versus previously we are just looking at 1 rate hike at the end of the fourth quarter of this year.
Okay, thanks, Zamros.
Thanks.
You cut your GDP forecast for Thailand despite the decent export data in February. So what's the rationale for the GDP downgrade?
Good morning, everyone. We cut our 2022 GDP forecast to 3.2% from the previous 4%, as the Russia-Ukraine war will weigh on global and EU growth and affect Thailand's manufacturing and exports. While February exports remain resilient at 16.2% growth, the impact of the war will likely be more visible in March onwards, during which the conflict escalated. And the Federation of Thai Industries has recently cautioned that car exports, which account for around 14% of total exports, will likely miss this year's target amid growing concerns over a raw material shortage as well as surging prices. Second channel is on the tourism recovery, which is also clouded by a prolonged war. Russia accounts for 5.4% of tourism receipts in Thailand and is the 3rd largest source after China and Malaysia, while the rest of Europe accounts for around 18%. Thirdly, higher energy and food prices will likely increase inflation and weigh on consumer confidence, which has not recovered to pre-pandemic levels even before the Russia-Ukraine war began.
Okay, that's I think the government announced some relief measures as well. What are these measures, and is it meaningful enough to make an impact?
Relief measures worth 70 billion baht was announced last week to counter rising energy prices. Retail diesel prices will be kept at 30 baht per litre until end of April. But after that, the government will only subsidize 50% of any increase in prices. That's because the Oil Fuel Fund Office has already spent a substantial 62 billion baht to subsidize diesel and LPG prices since last year. Other measures that were announced for May to July, cash assistance for cooking gas purchase will be raised to 100 baht per month for welfare card holders. There will be a 250 baht per month oil subsidy for motorcycle taxis, lower electricity charges for eligible consumers, and lower contribution under the social security system from 5% to 1% for both employers and workers. While these measures could help to partly cushion the impact of rising prices, I think they are unlikely to be sufficient to be able to boost private consumption. If we look at previous measures in the past to support low-income workers, in 2021 when tight COVID measures were in place, schemes like the half-half co-payment program and the extra allowance for vulnerable groups have shown results significantly below the government's target. And also a recent survey conducted by the Nation newspaper found that many street vendors and taxi drivers were not satisfied with the government measures. They would prefer that the government freeze the price of all necessities, not just cooking gas or LPG for taxis. That's not it.
Thanks, GA. Maria, so you also see downside risks to your earnings forecast for Thai companies. Which sectors and companies face the biggest downside risks?
Yes, good morning, everyone. Yes, have been our last market compass graphically illustrated the various headwinds facing corporate earnings, which, by the way, are not really unique to Thailand. However, when we interface these variables with the basic structure of the economy, such as high household leverage and weak income opportunities, risk on demand is apparent. Sectors that we see as having downside risks are those that are domestic facing because pass-on mechanism may not work as affordability is absent. The list includes food services, FMCG, and commerce. Tourism could also be downgraded as our baseline case is for 9 million international visitors. And the number may come way lower than that if Europe goes into a recession.
Maria, remind us which Thai companies you have a higher conviction buy on?
Yes, our picks this time, we focus on companies that have some positive stories in the short term. Short term because there's just so much risk over the horizon. So these companies are CPO with same-store sales growth turning positive for all the store formats, convenience stores, cash carry, hyper and supermarkets. K-Bank for positive earnings momentum, partly due to lower cost base. IVL for higher volume and better spreads. LH, its high-end positioning insulates the property earnings, and there were also improved contribution of investment portfolio. KKP for strong loan growth, the best in the sector actually in the first 2 months of 2022, and bullish on fee income from the capital market. This company also has a high yield characteristic. Centel for the recovery in hotel operations and resumption of hotel expansion. CHG Hospital management fee will come in to insulate partly the lower COVID income. Q House recovery in property business as well and improved earnings from investment portfolio. GFPT, this poultry producer already has its replacement production facilities in operations, bringing in high volume and automatically higher margin. Then the last one is the undergarment maker Sabina. This will benefit from the reopening of physical stores. It still has small cost base and a growing sales via online.
Thanks, Maria. Chee Ting, I think in the plantation sector, lots of flip-flops and policy moves. So the Indonesian government has decided to replace export curbs now with an export levy. What's the rationale and implications of such a move, and will it raise or reduce the global palm oil prices?
Morning, Habib. Definitely lots of flip-flop from the Indonesian government. But the government believes that this latest move to raise export levies will have better chance in resolving the shortage of subsidized cooking oil in the Indonesian market ahead of the Lebaran festivities, as the earlier policies met with mixed success. Now, the Indonesian government is now allocating about $500 million from the palm oil export levies to subsidize the bulk and unbranded cooking oil. Each month, about 200 million liters of cooking oil will be subsidized for 6 months to keep prices at or below 14,000 rupiah per liter. The earlier export curbs had the unintended effect of curtailing the availability of palm oil to the global market, at least in the initial month of its implementation, which was in February, as exporters scramble to get the necessary proof and paperwork in order to get their export permits. As this period coincided with the Russia-Ukraine war, which started on 24 February, the supply of sunflower oil from the Black Sea region was also cut off. The twin effects of Indonesia export curb and the war led to spot month CPO futures recording its historic high of price of 8,163 per ton on 1st March on global supply disruption. On 18 March, the Indonesian export curbs were lifted, although higher export levies were introduced, whereby the maximum export tax for CPO is now raised to $575 per ton from $375 previously. The exporters are actually in favor of this move, as it is reverting back to the old system that had been in place for years. As exporters are now able to sell to international buyers with ease, Indonesia's supply concern disappeared overnight since 18 March. Spot price on the CPO futures is now at 1,500 ringgit per ton, off the recent peak to around 6,600 ringgit per ton right now as of last Friday. All eyes are now on the Russia-Ukraine war development and also upcoming Northern Hemisphere oilseeds planting for new price direction.
Okay, Chee Ting, last question. Are you expecting Malaysia to change or fine-tune any of its palm oil measures?
This is a tough question, Harbin, because downstream players in Malaysia had been asking the government to review the Malaysia export tax structure, as the Malaysian downstream players find it difficult to compete with the Indonesia downstream players in the export market. With the recent revision in export taxes, the Indonesia's downstream players' margins had expanded further at these high prices. Even before this latest move by the Indonesian government in January this year, the Malaysian minister was telling a group of industry players at the conference that the government is studying and reviewing the current export tax structure. Honestly, I'm not certain if any revision will happen anytime soon. The general election is rumored to be just around the corner. To restructure Malaysia's export tax at this juncture may possibly mean lesser income to the Malaysian smallholders, who are the main voters base in the rural area. So it is going to be a tough call by the government.
Great, thanks, Chee Ting. That's all we have for today. Have a good week, everyone.
To get our research reports, speak to your trading rep at Maybank or contact our sales desk. Also follow us on Spotify or Apple Podcasts. Have a good week ahead. I'm Noelle Lim on ASEAN Speaks by Maybank Investment Banking Group.